Welcome to Real Economy. This week we're traveling through France and Italy, taking a look at the state of European bank lending and the issues financial fragmentation is causing. We'll pick the brains of two of Europe's most eminent economic minds about the issue and how they see it being resolved. Then we'll tell the story of a tale of two financial states. One where small and medium companies are finding access to funds extremely difficult, and the other where new ways of lending are being fostered. It's a bit of a vicious circle. In a recessionary environment, small and medium companies find that their domestic markets shrink, making it harder for them to make money and therefore honor their debts. Banks then don't want to lend to these companies based on their risk profile, or the loans are so expensive they are unaffordable. So companies end up not borrowing the money they need to invest back in their businesses and therefore the economy. Financial fragmentation simply adds pressure to the system. So what is it? Here's our jargon-busting crash course.
For 9 years, a single currency created a European money market that worked as one. Put simply, interest rates across different types of loans started to converge, whether you were in Paris or Milan. The financial crisis means government debt has become expensive in many countries. In turn, this has created big differences in interest rates. Some banks claim to be struggling to make a profit because of the narrow gap between the amount they pay to depositors and the interest borrowers are charged. Other banks are hesitant to lend to banks in countries perceived as risky, making funding expensive in these places. So a person or a company in a so-called risky country with the same risk profile as someone in a safe haven country won't be able to borrow the same amount of money or be eligible for the same interest rates, creating financial fragmentation.
The starkest examples of fragmentation can be found in Spain and Italy, where companies can pay up to 1.6% more on their loans than, say, in Germany. In addition, while loans to households haven't really changed much through the year, loans to private sector companies are sharply down, according to the European Central Bank's latest data. The demand for loans is down as well. So Gianni Maggi decided to trek down to beautiful Perugia in central Italy to find out why banks are having such a tough time lending.
150,000 people live in Perugia, a medieval town whose economy relies on tertiary services such as tourism and small industry. What's hard to find here are large amounts of capital for the town's small businesses. So access to credit becomes essential for these areas.
The limited availability of credit is one of the particularly hard-hitting consequences of the crisis for families and small businesses. So let's get to grips with what causes this phenomenon by taking a look at a typical household.
Our cameras peeked into the life of a typical Perugia family with 3 student children. In this house, mealtimes usually involve someone asking their parents for something. This lunchtime, Andrea asked for money to buy new basketball gear for his upcoming games. Mom Rita and Dad Maurizio had some tough love to dispense.
No, Andrea, it's not possible. Times have changed. We have to save and put more money aside.
Andrea, it may be possible, but we have to make some choices. You'll have to give something up, especially since you also have a trip planned. We must try to keep our expenses to a minimum because we have to reduce our bank debt.
Rita's response is more or less how we'd expect financial fragmentation to look. She wants to save for the family, which is effectively recapitalisation, something banks now need to do. Maurizio's decision to reduce their bank debt is the same as banks deleveraging. Banks reduce their total debt by debt restructuring.
Recapitalisation and debt reduction are fundamental to overcoming the crisis and addressing financial fragmentation. But this creates the risk of hindering growth and fostering recession. And as with our family in Perugia, these are factors that make banks reluctant to lend money.
So we asked the president of a small local bank, what's holding them back? In the Italian provinces, smaller lenders can maintain a direct and personal relationship with customers, but they must also comply with national and European standards.
With the onset of the crisis, the big banks stopped offering loans. Not us, though. We carried out a counter-cyclical operation, which means that we gave too much credit. Then in 2012, we slowed down lending. Now we've regained good liquidity. However, we don't lend at the moment because demand has slumped.
Since restructuring in the 90s, most Italian banks have been incorporated into big alliances that compete with major European groups. But the fallout of the Eurozone crisis has made it hard for them to compete on both the European and global stage.
Picking up on Gianni's Italian experience, I caught up with two of Europe's most eminent economic minds, Jean-Paul Fitoussi and Jacques Attali. Both of them had very similar yet differing opinions on the issue. How do you view financial fragmentation and its impact on the real economy?
People are not interested in taking risks. People are more interested in buying bonds or buying stocks on the markets because they have some kind of liquidity, and the difficulty is to find resources, long-term resources for SMEs or venture capital.
As you know, loans to SMEs are always riskier than loans to big firms. So there is a kind of credit crunch would be too big a word, but of credit rationing.
How difficult is the road ahead for both banks and SMEs?
We know that in Europe, the lack of regulations and common supervision allow to hide the fact that there is a need for at least 1,000 billion euros of recap for the European banks. Recapitalization means also restructuring, group merge, etc. It's a huge and terrifying tsunami of the financial sector.
What will it take for European banks to participate in the growth story?
To create a backup or a collateral for banks to push them to trust and to invest. And those kind of collaterals cannot come from something else than state or ECB or EIB. And to be very technical, I would say that today what is needed is a joint venture between EIB and ECB to create a new window or a new financing tool that will go through the banks to finance the SMEs. That could really be a real strong impetus for European growth.
It's really a tricky problem. You have to, for the banking system, to give loan to SMEs, you have to create a market for SMEs. Otherwise, the activity of the SMEs would not be profitable, and they will have no means to repay the debt.
We must improve the trust between banks and SMEs, and for that, some regulations are needed, but what is more needed is the trust. To know more through your own channels and others, success stories. For bankers to understand that we have a lot of potential if they trust entrepreneurs.
Thank you so very much.
Thank you. Bye-bye.
Building trust to foster lending is key, as is making these banks safe. New regulations means they have to get rid of their bad assets and have been shrinking their balance sheets and will continue to do so. It also means holding on to more cash as buffer. But critically, this ends up with banks lending less and then only to customers they consider safe. So if banks have to play safe and cannot take big risks for making profits, who and what fills that lending gap for SMEs? Gianni Maggi took another trip, this time to the south of France, to find out.
Global Technologies, an electronics and mechanics company in Aix-en-Provence in the south of France, is an example of a small business that's launching itself in high technology. What started as a maintenance and repair company is now active in the field of nanotechnology, with promising applications of energy storage in batteries, biomedicine and environmental protection.
Today, pursuing a strategy of growth and innovation is practically a requirement to ensure your company still exists tomorrow and to ensure you cope with the technological challenges of tomorrow. Finally, I think one of the major challenges over the coming years for SMEs, such as those in France, is certainly to move increasingly towards major exports, whether in Asia or the United States.
Growth requires funding. Global Technologies received funding from a local bank, which participates in the European Jeremy project for the Provence-Alpes-Côte d'Azur region.
The Jeremy Packer Guarantee is a completely original plan, which allows a maximum of 80% of funding free of charge. In addition, the director's personal guarantee is limited to 50% of his engagement.
The European Union's financial tools amount to more than 12 billion euros, including structural funds. The member states have taken on more than 900 regional projects, intended largely for companies. It's estimated that, at the end of 2012, these tools have contributed to the creation of over 44,000 jobs.
There are various types of financial support tools for small businesses, such as individual lending, for example.
Basically, you see the large banking institutions or the financial institutions not moving, mainly because of regulations, but also because of their own dynamism in addressing the sector. And so in parallel, it opens a market, I would say, and there is a gap, and this gap is going to be filled by entrepreneurs starting alternative solutions, such as peer-to-peer lending platforms, to address this need.
Well, that's a wrap on this episode of Real Economy. Join us next time to continue the banking conversation when we'll focus on the proposed European Banking Union. What does it mean? And will we get there? Until then, thanks for watching. Goodbye.